Cash flow is one of the most important parts of a buy and hold investment. A lot of times it's going to impact how your investment's going to perform over time. Whether you're looking at a shorter term investment over the next 5, 10 years, or you're looking more long term over the next 30 or 40 years, making sure that you have a positive cash flow and you're actually making money on the monthly basis, not just when you sell the property through appreciation. It's a very, very important part of making sure that this is a viable and profitable investment. With that said, most people go into an investment and they think of a few factors that play into the investment when they're calculating their numbers. In this video, I'm going to go through all of the factors to take into account when you're looking at an investment property so that you can accurately predict the cash flow and how much money is going in your pocket. All right. So step number one in this process is going to be determine the actual cost of the investment. This is going to be made up of a couple different factors. First, you're going to have the acquisition cost of the investment, obviously, what you're going to pay to purchase it. Second part of that is going to be the closing costs. These are real expenses associated with the property. You're probably going to have transfer tax. You're going to have title insurance. You're going to, if the property is vacant and you're renovating it, you're going to want a builder's risk insurance policy to make sure that that property is properly insured throughout the renovations and the vacancy in that house. In addition, you're going to have some miscellaneous title fees and other expenses that go along with buying that property. All of these I'm lumping in under closing costs, but they're very important to make sure that you understand them and that you can build them into your cost structure and offer structure on the property. The last expense that you might have that is associated with the acquisition is going to be the renovations. There's going to be an expense. Even if the house is in really good shape, there's probably some things that you want to do. Even if it's just painting the house or putting down some new floors or just getting the place cleaned, there's going to be expenses there. We lump that in, and that's our total cost of investment. All right? It can be cash out of pocket. It can be a loan. It can be, you can finance this in a number of different ways, but the bottom line is that's our cost. Second part of the calculation is going to be our income. Typically on a single family home, you're going to have one source of income. That's the rent. Pretty simple. There are other sources of income that we can calculate as well. And, if you've got a multifamily or you have a property in a right location, sometimes you can lease out the roof space. We had a client years ago that had a 6-unit building, and on the roof, they had cell phone towers. And they made way more money from the cell phone towers than they did from the rental units. And it was a really nice investment property because of that. So you want to look for opportunities like that. Another area that you can build in additional income might be from, if you have a multi-unit property, put in a coin-operated laundry. You can kind of anticipate that there's going to be some income on that side. But, I'm going to leave this up to you and your ingenuity to kind of look at each property and get an idea if there's an opportunity for additional income. Garages are another area where you can get additional lease space just by renting out a garage. In this case, let's just anticipate that we've got the rent rate, but guess what? The place is not going to be rented all the time, every day, every week, month, year. You're going to have some vacancy, which is going to impact your cash flow projections. If you do not have experience with buy and holds, with placing tenants, things like that, I would recommend that you calculate it at least an 8.5% vacancy rate, if not higher. 8.5% is losing 1 month's rent on an annual basis. 1 month. Okay? So if it takes you a month to clean up the property and find the next tenant, guess what? You have an 8.5% vacancy rate. You got to take that out of the income to calculate this correctly. If it takes you 2 months, 17%, and it escalates. So getting these places rented quickly and getting them turned over quickly is really vital to maintaining a good cash flow investment. Okay? Now, the area of this calculation that has really the most impact on the bottom line is over here. These are the annual expenses. And what are some of the annual expenses that you can expect to see? Not almost every, but there's, if you're in an urban area, almost guarantee, even a suburban area, almost guarantee you're going to be required to get a rental license on an annual basis, have the township or the city come in, inspect it, make sure it's up to par, and they're going to charge you for that. In Philadelphia, it's $50 a year per door. Not not a really expensive cost here. Utilities and HOA or homeowner association or condo association fees. These two may or may not be part of it. If your tenant is required to pay all of the utilities on the property and they pay them in their name, don't worry about it. That's a zero. But sometimes, especially multifamilies, we run into this a lot. There's one water meter. Now we can charge the tenant a flat rate, but if the utilities are not metered to the units, you can't charge them based on square footage, or if we can't say unit 1 used 80% of the heat this month, you can't charge them 80% of the bill. So you got to make sure that they're metered. The homeowners association and condo association fees, these are going to vary from property to property, but they're an ongoing expense that's going to be there. It's not going to go away. They're expenses on a monthly or annual basis that you have to calculate. Taxes. Hey, taxes, unfortunately, what do they say? Death and taxes, they're two constants, right? There's going to be taxes on the property. It's probably a school tax and a property tax. Make sure that you know what that is and you calculate that into your cash flow. Next, we have insurance. With as a landlord, we our insurance rates are going to be a little bit lower than if we lived in the property, but typically the insurance is not going to cover any of the belongings in the house. It'll just cover the structure. Make sure that you get insurance that is going to cover you for your investment. Make sure that you're not underinsured, so that if there is a problem, you're not upside down on on the property. Leasing. Okay, so the next few annual expenses here are often not seen in when calculating a cap rate on a property, and they are good way. I don't like cap rates typically because it's a good way to hide expenses, and these are the expenses that are hidden. So leasing fees. All right, if you've never leased a property before, you've never had a tenant before, I will 100% recommend that you find a leasing agent to place a tenant in the property. Somebody that does this for a living. They know what to look for in a tenant. They know how to advertise and bring them in. And at the end of the day, they're going to charge you a month's rent to place a good tenant that you're going to approve into the property. Very, very, money well spent. Okay. So, but you got to calculate it or it's going to impact your cash flow. Management. Okay. You can hire a property management company for 4%. You can hire a property management company for probably 12 to 15% on the high end. Make sure that you know what you're getting when you hire a property manager, and make sure you calculate their fee into your cash flow analysis. I would recommend to anyone to interview and at least get an idea of the property managers in your market where you're looking to invest, and make sure that they are quality, that you feel like you can trust them, and that ultimately you both have the same goals when you're you're looking at a potential investment. Maintenance. Okay, so on our properties that we renovate, they're blown out. We do everything. Top to bottom. We shouldn't really have any maintenance costs. In fact, our investors, they get a warranty for the first year of ownership, so that they have a zero maintenance warranty. Any expenses we cover and we take care of. But even if you don't have any maintenance expenses on year 1 or 2 or 3, all the way, maybe you don't have any maintenance expenses for 5 years. Well, guess what? They're going to accumulate, and when that tenant moves out, you're going to have some expenses to deal with. So make sure that you're budgeting for that in your cash flow analysis, so that you don't blow all your, your income for 2 or 3 years getting the place ready to put in a new tenant. Make sure you're putting that money aside. And last but not least, capital expenditures. So capital expenditures are money put aside to replace things. Okay, so we got a new roof on the house. That's great. It's got a 15-year lifespan. It cost us $3,000. $200 a year should go into the capital expenditures account, so that in 15 years we can replace the roof. The money's sitting there. Same thing with the heating system and plumbing system and the flooring and the wall, all that stuff. You can break down a capital expenditure, so money's put aside on a monthly basis. So now when it's time to replace it, the money's sitting there. It doesn't impact your cash flow, and at the end of the day, it's a great investment. Once we have all of these expenses, once we have all of these calculations for our cash flow, or I'm sorry, not for our cash flow, our income, and for the cost of the investment, we can calculate our cap rate or capitalization rate. This is a really simple calculation. What we do is we take all of the annual income adjusted for the vacancy rate. We subtract out all of our annual expenses and divide that number by our total investment expense. Really simple. This number, if calculated properly, will give you a litmus test of whether or not this is a property that looks advantageous to move forward with or not. Once you get that number, you can follow this process really simply, really on any property that you're looking for. With this video, if you are interested in downloading a copy of our cash flow analysis that we use on every property, I'd like you to email me at joshw@tcsmgt.com. I'll fire you over the calculator. You can take a look at it. We have some options there to include finance terms and interest rates and refinance rates, all that kind of stuff, so you can play around with each property and see what your best options are. All right? So that's it for today. Thanks so much for joining me. Again, keep an eye on the cash flow, because at the end of the day, this is the lifeblood of your business. Thanks so much, and until I talk to you again, I wish you the best of luck in your real estate investing. Take care.